Good afternoon. I hope everybody is doing well. It's another week, and we are hopefully rested and doing well after spring break. It's good to have that time in the semester to kind of recharge and refocus. I encourage you to refocus and work hard, as we really only have a couple of weeks left, and we're in what I consider to be kind of the topics, portion of this course. When you really look at things, the first couple of weeks feels very, very fast and quite a bit of information. And it feels like we slow down to some degree and really get to delve into the topics a bit more specifically at this point in the semester. So that's what we're doing this week. And we're going to discuss something that we've looked at and we've talked about previously, but we've not really defined and dealt with in great depth. So we're going to do that today, and that's going to be our liabilities. So I'm going to share my PowerPoint for the week. I want to back up real quick. So the text, and I like this definition, they define liabilities as items that are due from a past transaction or event. And so when I think about that, if I make a purchase and at the time of purchase, I don't give up, really think about the way that you would purchase something, I can do it in one of two ways. I can give up one asset for another. In other words, I can buy something with cash. And at that point in time, I don't have a change to the bottom line, but I have a change to my composition of assets. So if I buy supplies of $1,000 with cash, then my cash is credited for $1,000, my supplies are debited for $1,000, and my total assets remain unchanged, but the composition changes to some degree. If I took that same transaction and I purchased supplies with a liability, a current liability, something that's going to be used up within the course of the year. If I did that, then I'm going to see an increase in my assets by $1,000 in this example. But I'm also going to see an increase in my liabilities because while I now have this additional asset, I also have this additional obligation to pay this back at a future date. And so we'll look at some classifications there, but I want to take just a second and break this down. The text defines, and I agree, current liabilities are liabilities due within 1 year of a company's operating cycle, if longer. Long-term liabilities are due after 1 year of a company's operating cycle or longer. So if I looked at that, perhaps I've got a large asset that I'm purchasing. Maybe I'm buying a building, or maybe I'm buying a vehicle. In that situation, I'm going to have something that I'm paying back on continuously as far as that goes, but I've incurred a liability that I'm going to be paying on for quite some time. If I've got a car, for instance, and say I take out a 4-year loan to buy this car, well, that's going to be an obligation that I incur over the next 4 years. And each month when I make payments, I'm reducing the amount of that liability. I'm increasing the amount of the asset that I own at that point in time as well. And unfortunately, I'm also devaluing the car as it ages. But at that particular point in time, that's how the transaction occurs. So we've got a couple of things to look at here. I want to give you some known liabilities. Accounts payable, sales taxes. So when you think about this, we'll look at an example here in just a second. Unearned revenues, notes payables, and that sort of thing, just to name a few. So again, from our earlier lessons, anytime you see the word payable, you know that that's going to be a liability. And so on August 31st, Home Depot sells materials for $6,000 that are subject to a 5% sales tax. So when we do this, they're going to receive cash for $6,300 because what's going to happen is they have to remit sales tax for each sale. And so they're going to pass that on to the customer, which is true for most businesses. So at that particular point in time, we take the amount of the sale, which is $6,000, and multiply it by 5%, and we get $300. That goes into a liability account because that sales tax must be remitted at a later time. It's an obligation for them because as they have sold and as they have recognized revenue, they now have to pay that back at a later time. And so that's what we're looking at there. Unearned revenues. These are situations where you have sold a service that has yet to be performed. And they give an example that on June 30th, Selena Gomez sells $900,000 in tickets for 3 concerts. She has not performed these concerts at that point in time. So it's a liability because she has yet to earn the revenue. The revenue is essentially what's going to happen is the asset comes on hand at the time of sale. and the liability is the unearned revenue. Now, as each of those concerts is performed, assuming that each one is $300,000 or roughly that, after she's performed one concert, we then have a debit to unearned revenue. And again, keeping in mind this is a liability, so that $300,000 offsets the $900,000. So unearned revenue then drops to $600,000. And at the time the performance takes place, we then recognize the revenue. So on June 30th, in this situation, all that we did is we increased assets and we increased liability. We did nothing to affect the equity section at this point in time. As the revenue is earned on October 31st, when the first concert takes place, we then recognize the revenue. So we're going to do this in the period in which it's incurred, which again goes back to the matching principle we learned about in chapter 1. So that's an example there. We've got a couple of examples here on short-term notes payable. So with that, we've assumed in our current liabilities and our long-term liabilities that whenever we have accounts payable, we're looking at something that's not interest-bearing. Notes are interest-bearing. And so we want to look at that because we're going to have to record the interest. And a lot of times it's not clean. And I like the fact that the text gives you some good examples of when that happens, that it doesn't end right on the end of a month. You've got a partial payment or that type of thing that we're looking at. So some examples that may lead to a note payable would be an overdue account payable, borrowing from a bank, those types of things. Again, interest bearing. So we have an example here. On August 31st, Brady Company asked McGraw to accept $100 cash and a 60-day 12% $500 note to replace its existing account payable. So at that point in time, you had an account payable that has now been paid up essentially with cash of $100. And so the other side of that is a note payable that is going to be interest bearing. At that point in time, the account payable originally had a $600 credit. It now has a $600 debit, so it is off the books at this point in time. What has been replaced is a reduction in cash of $100, and we now have incurred a note payable of $500. So let's look at that. If I've got a 12% note, keep in mind the formula for interest is going to be principal times rate times time. So again, this is your principal right here. This is your rate, and this is 60 days. When you're calculating interest, you're going to assume the number of days divided by 360. So if I'm doing this, for instance, I've got $500 times 12%, but that's an annual rate. So I take 500 times 12% times 60 divided by 360. And so when I do that, I'm going to come up to $10. 500 times 12% times 60 divided by 360 gives me $10. When I go to pay this off, I'm going to pay cash at whatever point in time, 60 days after the note, cash of $510 at that point, because I now have to also pay the interest. So I've got, at that particular point in time, an offset to the 500, which we see over here. The original note payable is going to be reduced over here to 500. So now that's gone. I'm going to recognize 10% in expense. And I recognize this as of the month in which I paid off the payable. Because again, as we wanted to recognize the revenue in the month in which it's earned, we're going to do the same thing with expenses. And then, of course, because it was interest bearing, I'm paying more now than what I originally borrowed. So originally I had incurred a $500 note. Because it's interest bearing, I now have a $510 obligation I have to pay back. 10% of $10 of that rather is interest expense. 500 of that is note payable. Another example, note given to borrow from a bank. On September 30th, company borrows $2,000 from a bank at 12% interest for 60 days. So again, same rules apply. $2,000 times 12% times 60 divided by 360 is $40. So when I'm borrowing, when I pay that back, I'm going to debit the note payable for the amount of the original principal balance. I'm going to debit interest expense to recognize the interest that I've earned, and then my credit is going to be a cash credit for the amount of both the note payable and the interest expense that we recognized. So There we go. And let's see here. We've got some examples of some end of period adjustments. I think this is really good to look at as well. Sometimes you may have, and I like that they did this. You may have a 60-day note that you took out mid-month. And so that's kind of what they've done here. They borrow on December 16th, the company borrows $2,000 from a bank at 12% interest for 60 days. Now, again, we're going to have to do an adjusting entry as of December 3rd and 31st. And why we want to do that is because we want to recognize all of the expense, particularly on December 31st, within the calendar year. So at that point in time, this was a 60-day note. But if I took this out on December 16th, I need to find out how much interest I needed to pay as of December 31st, because that's the end of the year. The same thing will be true on revenue. We want to close that out cleanly. So what I'm going to do there is simply do the math, subtract 31 from 16, that's 15, and I'll run the same calculation. $2,000 times 12% times, in this case, 15 divided by 360. And that gives me interest expense of $10. That's what I will be recognizing as of December 31st. On February 14th, again, 2 months after the transaction has taken place, and when this whole thing is due, I'm going to then recognize the $30, which is going to be the remaining 45 days of the original 60 days note. Again, 2,000 times 12 times 45 divided by 360 gives me 30. I had an interest expense. I had an offset from interest payable. So again, how we looked at that as of December 31st, we basically incurred another liability. Again, we haven't paid off the full balance of the note yet, but we've recognized interest expense from interest payable at this point in time, similar to what you did during sales tax payable, and pay it back at a later time. I don't want to incur a further expense in the time period in which it's not earned. And so that's why I leave this as a liability, because again, liabilities are a permanent account, whereas expense rather is a temporary account. So I have my debit and interest expense on February 14th for the remaining 45 days. That's $30. I have my debit to interest payable. This wipes out the liability I had incurred from the previous year for $10. I have my debit to note payable, again, from something that happened in the previous year. And then my credit at that point in time is going to be $2,040 for the amount of cash that's going to have to go out to pay for each of those things. So nothing terribly difficult, I don't believe. I mean, as far as that goes, the biggest thing there, and probably the most common mistakes that I see, is miscalculating the interest, failing to divide it by or dividing it by 365. Again, watch the verbiage. If the problem tells you to divide by 365, and I don't believe there are any that do, but if it tells you to do that, be sure to put that in as your denominator and not 360. But in most cases, it's going to be 360 that you're going to divide by. And then really from there, the computation is the same. Other mistakes that I see is I have seen examples where people will try to pay this with cash. They'll do interest expense and then recognize cash there. You really don't want to do that, because a note is going to end up being paid at the end of a life as far as that goes. So that's why we're going to book this as a payable on December 31st. Other than that, I think for the most part, it's pretty straightforward. But again, as I've said in the past, if you have any questions, we can definitely look forward to seeing if I can provide some clarity there. I'm going to do a separate lecture talking about payroll expenses. And I think this is interesting because it affects every one of us. If you've ever had a paycheck, you've had payroll taxes taken out. So we'll get a chance to see that flow and that process. And I think that will help to kind of understand both your side and both your employer side in terms of how that all works and fits together. But I'll do that a little later in the week. In the meantime, have a great afternoon, and I will talk to you later. Bye now.